There's a lot of mixed messages in the market at the moment. It's unclear where rates and inflation is going to get to and where the market is going to start to recover. We have a special guest here today, Martin North from Digital Finance Analytics. Martin, thank you very much for joining us today.
Hello, good to be back on again, and I hope you're well.
Thank you. We've seen Tim Lawless from CoreLogic, the National Director for Research, tip that the housing market correction will bottom out in the first quarter of 2023, followed by a swift recovery after that. We've seen a lot of predictions out there. Do you believe we're going to see a V-shaped recovery, or what do you think the recovery will look like?
Well, I think it's all about where interest rates are going to go, because it's very important to understand that movement in house prices is going to be determined by credit availability, and credit availability is in turn determined by where interest rates go. Now, at the moment, of course, interest rates have moved up. The RBA's moved the cash rate up 6 times since May, and the last one was 25 basis points, and they did say they're going to do some more. And the markets at the moment are saying they're going to take it up to about close to 4%, and then it will stay there through the whole of next year and into 2024. Now, the point there is, if that's true, and if the rates stay high, it means that borrowing power will continue to be reduced substantially. So if you go back to where we were before May, compared with now, the ability to be able to borrow up to the hilt is down by about 25 to 30%, depending on the particular circumstances. But that's the first point to understand. So if credit remains tight and interest rates high, I'm not sure that we're going to see a sudden reversal in the falls that we've seen in the housing sector. Second point to make is, although the RBA has announced 6 rate hikes, only the first 3 have actually percolated through so far into hitting households in their back pocket, as it were. Because when a bank gets the message from the RBA that cash rates going up, the bank then has to communicate that, having made a decision. That communication process normally takes about a month. Then they have to make the changes in the systems, and then they have to run the monthly cycle. So it's 2 or 3 months. CBA says it's about 3 months, right? So that would mean that only about half of the increases that variable rate borrowers have come through yet. So you would expect to see that continuing. So that's sort of the first question. Now, if you have a view like CBA that cash rates aren't going to go up to more than 3%, and they might come down sort of early next year, whole different ballgame. The question is, how likely is that? Well, the market is saying that's not what they think at the moment. And bearing in mind, of course, the Federal Reserve is likely to raise 75 basis points in early November, bearing in mind that inflation is still very strong here in Australia as it is around the world, I'm skeptical that the RBA is going to stop lifting rates anytime soon. So that's the other side of the equation, and is migration, because migration is starting to pick up now. And we are going to see migration, particularly in the new year, I think, start to pick up. And that's going to be an extra level of demand. And that could actually counterweigh some of the further falls in prices. The third point to bear in mind is that, of course, property investors who were very strong until quite recently have started to walk away now because there's no capital growth. And if they don't believe there's going to be capital growth, and the costs of actually borrowing are going up, and that means that your property investments losing money on a cash flow basis without any capital appreciation, property investors will not be back. So there are so many, it depends, it's hard to know. My own central case is a fall of about 20% from top to bottom, and we're not there yet. And I think it's going to probably take a few more months than Tim thinks, but by the middle of next year, if rates have actually stopped going up, and if migration starts to pile in, we might start to see prices begin to settle. I have my doubts that we're going to see a significant further run-up. Remember that the run-up that we had through the COVID was completely artificial, because they took the cash rate to 0.1%, and the government, through stimulation left, right, and centre, home builder and those sorts of things, they're not going to do that again. So even post the RBA stopping lifting rates, I don't think we're going to see interest rates dropping back to where they were, which is going to very much restrict the potential growth of prices into the medium term.
Certainly will be interesting to see how things play out there. And I know you mentioned your prediction on property prices to drop by 20%. We know that credit availability is closely tied with property value growth. Do you see any regulatory changes? We saw in the UK, they've got one lender offering 50-year terms. We're seeing debt to income ratios increase over the years. Even in Australia, the loan term increased from 25 to 30 years only in the last sort of 10 so years. So do you see any regulatory changes come into effect if the Reserve Bank continue to increase rates, whereby they might make a potential easing for borrowers to borrow money?
It's 3% above the current mortgage rate. Now, that's to give a bit of headroom. Of course, some people will now have their mortgage rates higher than that 3% buffer if they got them at the wrong time and when the rates were ultra low. Now, I guess there's an argument to say that APRA might say, well, actually, now that rates are, 3 or 4 cash rate, which means the mortgage rate's 6 or 7 probably percent, maybe we don't need 3%. Maybe we can take the buffer down. So APRA might do something. There is a possibility that we're going to see longer term rates and almost intergenerational mortgages are certainly available in other places. I personally am not that. And as you extend the loan, extend the life, I should say, the monthly payments don't go down actually that much from 25 to 30 to 35. It goes down a bit, but not a lot. So I'm not sure there's a huge amount of headroom or appetite for that. But then you've got the other issue that housing affordability is way off the scale still, and people need 6 or 7 or 8 times their income to be able to afford in many places. So it depends, I guess. If prices come back, that might bring a bit more momentum. But at the moment, if you look at affordability, it's no better than it was 6 months ago because incomes aren't growing. The ratios are lower because of the 3% buffer on a higher amount, which means you can borrow less. So I'm not sure there's going to be a massive switch in sort of parameters that I can see at the moment.
And why is Australia so property focused? We see other countries backing businesses with their business lending. Australia is so limited in the fact that, small businesses go to get loans, they get reamed, they get asked 100 questions, and then they get told no. In Australia, you go for a mortgage. It's a pretty easy process, done, dusted quite quickly. So why is Australia so focused on property?
I think there's a bit of history here that people have seen very strong property price moves. Over the last 20, 25 years, prices have gone up. But you've got to understand why that was. They deregulated the financial system. They took interest rates down to that ultra low level, and they increased the income multiples so that basically you could borrow a lot more. Now, all of those levers, run out of smoke eventually. And so we've had a generation or two who actually believe that property is a surefire bet. My surveys still say that a lot of people think property prices religiously double every 7 years, right? So property values. Now, actually, factually, that isn't necessarily true. Depends where you look, because different properties in different areas function very differently. But we do have that. The other point is, of course, that there are some very generous tax breaks for property investors, and particularly on negative gearing and those sorts of things. And that's another reason. We have 33% of all mortgages are actually for investment purposes. That's double what it is in the UK. And it's interesting, the Bank of England got really twitchy when it came up to 16% of total mortgage lending for investors. They throttled it back. Haven't done that here, although they did make some minor changes recently to some of the expenses that you could write off. So we've still got very favorable tax structures for investment purposes. I have a feeling, though, that this real spike that we've seen over the last 20 to 30 years, I think it's a bubble, may not actually replicate itself. And therefore, we might start to see a bit of an alternative story ahead. The other point to make is if you go back 20, 30 years, 1/3 of bank lending was for mortgage purposes, 2/3 was for business purposes. That's been reversed. So now the banks are predominantly mega building societies, right? So 66, 67% of their lending goes to mortgages. Then they lend a bit more to the construction sector. So a lot of it is actually around construction. Much less is actually available to businesses. And I see a lot of business in my survey who just cannot get the finance they need to help grow their businesses. So we have a really warped financial system because of this fixation on the credit for houses and units. And we also have people who in turn have got used now to paying a lot more than they did in terms of multiples and size of mortgages and those sorts of things. So we've got this sort of vicious circle. And it was virtuous for a time, but I have a feeling the spiral could work the other way. And that's why some of the things I'm concerned about are some of the risks in the system that we've got now.
This concludes part 1 of our 3-part series with Martin North. In the next 2 videos, we're going to continue where we left off in trying to get some clarity of where the market's likely to go. So join us, hit that subscribe button so you're up to date with when we post the next video. And guys, thanks for watching.